coming on. I really do appreciate it. And thank you for accepting my invitation to come on the X22 Report Spotlight.
Well, I'm looking forward to discussing all these big issues with you.
Yeah, I mean, I just have to say, just the last couple of days have been absolutely crazy with the market, not just here in the United States, but in Asia, Europe, the United States, of course. And you hear the corporate media and everywhere else. They're just, everyone's just talking about all different things. And, I just want to, hopefully with this, we can clear up some of the things that are going on. And I mean, we see out in Asia and Greece and Europe, we see that the economies aren't doing as well as the central banks, the governments have been telling us. And it looks like they're starting to break down. Are you seeing the same exact thing?
Yes, Dave. And, I've long had an interest in Asia, maybe partly because I grew up in Hawaii, and I've studied Japanese language and, traveled to Korea, Japan, and China multiple times. So, so I'm particularly interested in China because, of course, it's the most amazing, growth story of the last 100 years. The phenomenal growth of China's economy. And so therefore, the fact that it seems to be slowing down is definitely the big story because, as everybody knows, China's kind of been the engine that pulled the global economy out of the financial meltdown of 2008, 2009. And so if China falters, everybody knows there's really no substitute. No one else is going to go buy 100, million tons of this and that, iron ore, copper, soybeans, you name it. So if China's economy really does slow, then that is going to have a huge impact because there's no substitute.
Do you think that China is the entire reason why this is falling apart? Or do you think this is really ongoing? This is something that was really going, if we go back just, let's say to 2008, do you think it was just happening because of China right now? Or do you think it was something that's been happening in the past and it's just continuing on and now China is kind of caught in this also as we go forward?
Yeah, I think, Dave, from your question is the proper context of our discussion is what are the underlying trends which are now reversing or bearing different fruit than what people expected. And I think we can go back to the mid 90s, at least, 20 years when, what we might call, the risk on global speculative frenzy started. And by speculative frenzy, I don't just mean people saving money and investing it in tech stocks. I mean the leveraging up of phenomenal amounts of debt, right? In other words, people borrowing money and then using that money to invest in assets globally. And so that engine seems to be rolling off the tracks here. In other words, borrowing money like on margin accounts to buy stocks or borrowing to buy speculative, second or third homes or, house flipping, all these different activities we've seen. Those, we have to distinguish that kind of speculative activity from actual production of goods and services in the economy, right? And so the trends that I would sort of want to talk about is that speculative thing where we're pouring tremendous amounts of capital, a lot of which is borrowed, into gambles which if they do pay out, it's not because they boosted the production of goods and services that increased the wealth of the world. They were simply speculative plays in which nothing got produced. And so, in other words, that wealth that was created is what we call phantom wealth, because once the asset class, reverses course, there's really nothing underneath it. Like we didn't really create more wealth. And the other trend that's really kicked in since 2000, the early 2000s, is the tremendous intervention of central banks and central states. And so that's a game changer too, that never before have markets been so dependent on central bank and central state intervention and manipulation of those markets. You can call it management if you prefer. But what's the difference between management and manipulation? I don't know.
So, I mean, we've seen right now, I mean, from everything that's going on, we've seen the stock market, I mean, take a dive. I mean, we saw it go down 1,100 points, and we have seen it pumped back up. And they try to pump it back up. What was that, Tuesday? They called it Terrific Tuesday. They pumped it up, and all of a sudden it fell again. And now we're seeing all the markets being brought back up. I mean, to me, nothing's really changed. But what has happened in the stock market today? I mean, I know you have a couple of articles out there about the stock market. I mean, what is your viewpoint on this whole thing?
Well, Dave, I'm going to reverse that question and ask you at some point. I'd like you to, because you actually have Wall Street experience, and so and I'm just an outsider. So, but a lot of people believe that the nature of the market in terms of its day-to-day trading has fundamentally changed due to high frequency trading. And so a lot of people are claiming that this crash of the last week is has nothing to do with fundamentals or anything. It was all related to the way that 90 or whatever percent it might be, the majority of trading on the at least the U.S. markets are now computer programs, high frequency trading, and so that's created a vulnerability that did not exist like say 20 years ago. But I also have speculated that I wonder if this is just a rig job. In other words, if you want to make some quick money and you're a major player, then you can, kind of trigger a mini crash and then buy a bunch of assets on sale, and then 2 weeks later they're back up to where they were, and you've made some very easy money at the expense of people who panicked, or computer programs that picked up the momentum that was going down, so they sold. So, but I think those are sort of short-term questions. I think the longer term is what you spoke about earlier. Like, is the global economy falling apart at the seams in terms of the production of goods and services, employment, the fundamentals of sales and profits? And I think the answer is unequivocally yes. Sales are stagnant, and therefore profits are stagnant, and the return on investment is stagnant.
And I completely agree. To me, I have always said that the stock market is kind of the last indicator letting us know that this entire system is doomed. Because I noticed and you mentioned high frequency trading, and the plunge protection team, they try to keep the stock market up as long as possible until the very end. And when they can't do it anymore, the whole thing just completely falls apart. And I think that's what happened on Tuesday, actually. I think the plunge protection team, the high frequency traders, they had everything working, and at that point they just couldn't maintain it, and the market actually took over, and the whole thing started to slide. And because the rest of the world was not on the same page. I think the U.S. was trying to show that our markets were still good, and the Fed stepped in. They started creating money, started buying up stock to push this market up, and it just couldn't work. And we're seeing now, since that time, the Fed, since the market's going back up, is saying, okay, maybe we need to raise interest rates. Maybe it's time to do this. I mean, do you think the Fed is going to raise it? And if they do, will it hurt the economy?
Yeah, Dave, I think that's the $1 trillion question, or maybe the $100 trillion question. And your listeners are savvy, and so these are not new issues to most of them. But maybe we can go over a couple of the dynamics of interest rates, and yields, right? Because it's an interest rate if you're a borrower and you got to pay it, but it's a yield if you're an investor and you're buying a bond that, has some sort of return on it, So, what's happened in the last year, which has surprised a lot of people, and I can kind of pat myself on the back here and say, well, this is what to me looked inevitable, which was the rise of the U.S. dollar. And kind of if we go back to, the early 2000s and the housing bubble and that stock bubble of the mid to the period of 2003 to 2008 when stocks rose a lot, the U.S. dollar was being pushed down, by expansion of the money supply and the Federal Reserve had dropped interest rates. So so globally, if you're a money manager, let's think, well, what's your job? Your job is to maximize yield without taking on too much risk. So if yields in the U.S., the yield on a U.S. Treasury bond and a high end corporate bond are small, like 2, 3, 4%, and you can get 8% by buying a bond issued in Mongolia or Brazil or whatever, well then, what the heck? Why not get a double return, get 8% instead of 4%. And if the dollar is declining at the same time vis-a-vis these other currencies, then you're actually going to get a double return because, your bond in the Brazilian currency is going to actually be worth more because it's appreciating against the dollar. So this is where it gets tricky because all this massive capital flow is moving around the world, seeking the highest yield, not just in nominal terms, but also in the underlying currency. And so, to me, and I'm not alone in this, a lot of people have fingered this as a critical dynamic of why the wheels are falling off everything is throughout most of this last 6 years of bubble growth and stocks and real estate and so on, the dollar was weak. And so what made sense was for global money managers to borrow money in dollars. And of course, there's a lot of dollars floating around because the Fed, basically created almost $3.5 trillion or something.
Yeah.
And U.S. banks, of course, can create money too, right? That's
Yes.
the fractional reserve system. So there's lots of dollars floating around, and you could borrow them for very low interest rates. So you borrow dollars, and then you buy, rental vacation property in Peru, and you buy, farms in Brazil and, Mongolian bonds. You buy all this other stuff that's yielding much more face value, but it's also gaining value because the dollar's depreciating. And so what happened though is a year ago, the dollar started rising a lot. And so suddenly all those capital flows, which we call carry trades, when they're financial transactions, all those carry trades suddenly became unprofitable because instead of making a ton of money by borrowing in dollars and buying something denominated in another currency, suddenly you're losing money on that trade because the dollar's appreciating like crazy, and like the dollar's gone up about 20%, which in terms of currencies is a lot. And so now people are unwinding those carry trades, meaning they have to sell the emerging economy assets they bought and pay back the loan in dollars. And so I don't know if I've done a very good job of describing a fairly complicated mechanism, but that's partly why things are unsettled, and things look all these wild swings. People are trying to figure out where can I put my money that it's going to not just get devalued or depreciate.
And going on that, where we're seeing these wild swings and everything is unstable, and we saw the market falter, which a lot of people are saying this is like one of the first signs that something is wrong. Actually, we saw this back in 1929 during the Great Depression in August. The market did come down quite a bit. They pumped it back up. And then, of course, in October, we know what happened. Do you think when this system really starts to fall apart, do you think the Fed is going to be calling for, or maybe the banks or the government are going to be calling for quantitative easing to say, okay, we need to create money?
Yeah, Dave, I think we can look at the at the game plan, if you will, of the Fed and the federal government. And we can look at 2008, 2009 as their basic game plan, right? I mean, and that's the game plan, as far as I can see, that's being followed by the Chinese, authorities and the European Central Bank, and basically all the central banks in the world are playing the same game plan, which is, when things start faltering, you try to increase liquidity, like availability of cash, and pump their financial system up with a lot of cheap borrowing capacity in the hopes that people will borrow that money and buy assets and spend it wildly and renew growth, whatever. So here's the thing about interest rates that to kind of tie this capital flow thing in is, if the Federal Reserve were to raise interest rates now, or interest rates were to rise despite the Fed, as maybe people start fearing that their assets aren't safe and they start selling bonds, and therefore that pushes interest rates up too, that would tend to strengthen the dollar, because if you can earn a higher yield in dollar-denominated assets, then that starts looking like a pretty good bet compared to maybe riskier currencies elsewhere in the world. So that would actually increase the momentum of this carry trade unwind and actually unsettle things even more. And the reason why that is if you have the reserve currency or a major global currency like the euro or the Japanese yen, or the yuan, the Chinese yuan, or the US dollar, those central banks actually are playing to two audiences. And in other words, they have an international audience of people who use their currencies and invest in the currencies and use those currencies for trading. And they also have a domestic economy that's based on those. So this conflict between the international and the national was explored by this economist named Triffin. And so his thinking is now called the Triffin's dilemma, or Triffin's paradox, which basically talks about if you do something for your domestic economy, like either strengthen or weaken your currency, it can have an adverse effect in the international economy. And so that's where the Fed really has a problem, because it's got the dollar, that's the global reserve currency. And so whatever they do for the domestic economy, like maybe they'd like to raise interest rates to normalize, quote, interest rates. Maybe they think that's going to be a good idea for the domestic economy, but it's could prove deadly for the international economy, because it's going to make those carry trades based on borrowed dollars even more unprofitable and cause even more selling of other currencies and emerging market assets. And it's also going to push China to revalue the yuan, and we can see that that alone has caused a certain amount of panic.
So really the Fed right now is stuck in the middle, because if they do something with the interest rates, something's going to go wrong. If they don't do something, something's going to go wrong. So they haven't done anything.
Right. Exactly. And again, kind of going back to one of the themes we've been discussing, which is this massive, permanent intervention. In other words, like in the old days, and I mean the old days, meaning you could go back to the 60s, 70s, and 80s, when there was a sharp recession, the central banks would maybe lower interest rates a bit and increase liquidity for like a matter of months until the economy had recovered, like maybe a year at the most. And then it would reduce its intervention. It would let interest rates go back to where they were before and dial back its money printing and that kind of thing. Well, now for 6.5 years, we've seen the intervention is permanent. And so I think if I were in the Fed, and again, I'm just speculating because I'm not, I'm just an outsider, but clearly they want to normalize interest rates, like kind of finally get back to a more normal set of affairs. In other words, let interest rates rise back to where they were before this Great Recession. But as you say, they seem to be trapped, and they're afraid if they do start letting interest rates rise, then that will basically throw the global economy and the U.S. economy into recession. And if that level of fragility is new. In other words, if we've reached the point where the entire global economy spirals into depression the moment interest rates rise above 1/4%, then that's an extremely fragile and really sick economy.
Yeah, I think what happened in 2008 up to this point, everything they've done has just made everything worse than it really was. And I think at this point where we're headed, they have no options really, because they've created not just the U.S., but many of the, like Japan, the United States, Europe, they're just continually creating debt, and more debt, and it just hasn't stopped. And right now we see the entire world right now is just flooded with all this debt. And this is why people are worrying, like what happened in Cyprus, what's happening in Greece right now about, are my pensions at risk? Are my savings at risk? Are there going to be bail-ins? I mean, do you think that, from what you're looking at right now, are savings and pensions at risk at this point?
Well, Dave, I think they are, because, and you go, well, why? What could cause my pension or 401k to decline in value? And there's opposing forces, right? On the one hand, what it really goes back to is, have we created any real wealth in the last 15 years? In other words, wealth that generates more goods and services, or improves services, or lowers the cost of things. And this is what productivity is supposed to do, right? In other words, I was just seeing a program on some emerging medical technology, and these people are saying, our tests cost 10% of what the current tests are. Instead of, if Medicare says this test is, they will pay $250 for it, well, we charge $25 for it. This is the kind of thing that is supposed to improve wealth. In other words, right, we're creating a more productive economy. But if all we've done is just borrow a ton of money and basically drive up the value of assets without creating any real wealth, where has that gotten us? And I think that's really where your question goes to. It's, if all we've created is phantom wealth, then what happens when that phantom wealth goes away? Because it will, right? Because we didn't really create any new wealth. We didn't create that many more jobs or productive services, or, and in China, for example, because we're talking partly about the end of the China story, they've spent a huge amount of their capital on building, like, at least, I think the number is about 60 million empty apartments, which are basically savings accounts for their middle class. But, was that the best use of those trillions of yuan? And, Chinese debt, the total debt that China, private and public, has like quadrupled since 2007, from I think it's 7 trillion US dollars to 28 trillion. I mean, they've quadrupled the debt, and a lot of that money went into empty flats, ghost cities, big giant malls with 3 vendors in them. I mean, they've had a tremendous amount of malinvestment, and so we have to ask, what did we do with all the debt that all the money we've borrowed into existence? And I think the basic global answer is a lot of it has been malinvested, and so there's not a good return on all that money, and so that money is phantom, and it will go away.
And when you say go away, what are you saying?
Well, I'm saying that the value of those assets that will drop tremendously, perhaps by 80 or 90%. And you hearken back to the Great Depression, and that's a lively topic for a lot of reasons. But what we do know about the Great Depression is that stocks cratered by about 80, 90%, and so did real estate. Like, I remember reading that one of the big skyscrapers that had been constructed in New York right then at the 1929, 1930, it was eventually sold for the value of the elevators. In other words, the cost of the elevators, that was what the building sold for. I mean, the other 95% of the building, that value vanished. because it wasn't producing, income that would justify a higher valuation. So, an empty apartment in China that somebody paid 100,000 US dollars for, what's the value if it's not creating any income? What if the elevators break in that building, which they eventually will, and there's no money to fix it? What's the value of that apartment on the 19th floor that you have to walk up to? I mean, these are the kind of questions that come to mind when we start talking about phantom wealth. And so, frankly, a lot of the assets that are currently valued at this very high level, their value based on income and as a business proposition is maybe 95% less.
You wrote an article back on August 22nd. Is it time to get into crash positions? Do you think at this point in time where we are that it is time to get into crash positions because something is coming?
Well, Dave, I think we can try to answer that within the context of, again, the last 20 years. And we've experienced two gigantic asset bubbles, right? In the around 2000 and again in 2008. And 9, we saw those bubbles collapse despite massive intervention by central banks and central governments. And so to say that it can't happen again, we'd have to ask, well, why? What's different about this bubble from the two previous bubbles? And we're not talking about 1728 or 1929. We're talking about 7 years ago. It's
That's
not
true.
that long. And so if the game plan is the same, then what happens if that game plan fails? In other words, I think that's why I think we have to look at, is it time to get into crash positions, is the Fed can't lower interest rates by 5% because it's already basically at zero. And so they can push rates negative and force us, basically charge us money to have cash in the bank. But that's not going to be that effective. There's only so much they can do, and that's done. Okay. And then in terms of quantitative easing, like printing money basically out of thin air and buying treasury bonds with it to basically push money into the financial system, they can do that again. But I think the returns on that policy have diminished. And we can see it that from QE1 had an enormous impact on the stock market. The stock market soared, and QE2 had less of a response. And then by the end of their QE programs, QE3 and Operation Twist, the market was sort of lofting a bit higher, but there was a lot less punch for all those trillions. And so what I see happening is the Fed and other central banks may be forced to try this same game plan of quantitative easing and buying bonds and so on, but it may not work anymore, and so that would be the end of that game plan.
So let me ask you, do you see a collapse coming?
I think so. And I'm just like everybody else. I'm reading other smart people and trying to learn from them. And so part of why I think there's a crash coming is that life and especially financial markets tend to work on cycles. And so it doesn't take a huge amount of analysis to just look at how long bull markets last, and so no bull market lasts 100 years. You can have a stable economy with booms and busts that lasts 100 years, but you're not going to get a stock market that keeps going up by 20% a year for 100 years. At least unless you in an economy that's not being destroyed by hyperinflation. So after 6.5 years of a bull market, it would be normal to have some sort of reversal. And how long that lasts? Well, typically they last a couple of years. And so if we combine that kind of basic business cycle idea with the idea that the Federal Reserve and the other central banks, their policies have lost their impact, and that when they try it again, It's unlikely to have the same impact that it did in 2008, 2009. And so you put those two things together and you go, well, yeah, we're going to have a downturn. And part of it's just based on fundamentals like declining sales and stagnating profits, and the rising dollar, which is killing a lot of carry trades and killing overseas corporate profits here in the U.S. So those negatives will have an impact, and then you combine that with the sort of historical cycles and the fact that the Fed's game plan has lost its power. Then you say, well, then how big could the downturn be? And again, looking at the last two bubbles, it looks like a decline of 50-60% would be completely normal.
And back in 2008, when we were going through this crisis, bankers, corporations, congressmen, they were all on the floor telling, the government officials or government employees that, we need a bailout. We need the money to save AIG. We need the money if to save the banks. And if we don't get this, we're going to see, riots on the street. We're going to see, things happen that we've never seen before. I mean, at this point, do you think, since there are no more bailouts because of Dodd-Frank Act, are we going to see, resources dry up, like food, water? Because Bill Holter, Jim Sinclair, they were out there speaking, and they were saying that, credit lines are going to dry up, resources are going to dry up. It's not that the food disappears, it's that they just can't get those supplies into the stores when this whole thing comes crumbling down. Do you see the same thing?
Well, Dave, I'm certainly I'm aware of the possibilities of a breakdown in the financial system causing like a domino effect in the real world, right? Mm-hmm. And why this is a matter of concern, I think, if at least to me, is the global supply chain is actually quite fragile, and it's been stripped, if you will, of redundancy, because redundancy is a cost. And so to compete in the global markets, basically all the redundancy in our delivery systems have been stripped. And so, like say, if, for instance, gasoline, I mean, the average person has no awareness of how fragile that supply chain is. In other words, there's the gasoline that you go get at the 7-Eleven or wherever you go, it's like 3 days supply. And so, and it's all been set up on delivery just in time. In other words, that tank is basically almost empty when the delivery truck comes. And so, any disruption in that supply chain very quickly impacts the end user because there's no redundancy, and, so that's the fragility of the modern economy. In terms of like the financial system, I'm a little hesitant to predict a collapse of the real economy for the simple reason that the Federal Reserve and other central banks have the power to create money, right? At basically as much money as they want electronically, and so. It's entirely possible for the Fed to do even more extraordinary things. Now, I'm not recommending they do that, or I'm not predicting it, but like say if like for example, China sells $1 trillion worth of their U.S. bonds. Well, I mean, the Fed could actually print that trillion in 1 second and buy the $1 trillion worth of bonds from China. I mean, there's nothing to stop them from doing that. They've printed $3.5 trillion. They just did it over more time, but there's absolutely nothing to stop them from printing $1 trillion. Right. And so what they could do is they could basically take over any failed banks, just buy them outright. And that would have been a smarter move, right? I mean, if the federal government had bought Goldman Sachs and Lehman and written the whole mess down and kept the ATMs open, then that would have been a smarter move than bailing out the speculators. So there are still more extraordinary things that the Fed and the federal government could do to keep things afloat. But whether they will keep asset values sky high, that's the question.
Let me ask you, since you brought this point up about the Fed purchasing, I mean, they have been purchasing treasuries because when there's no buyer out there, they step in different covert ways and they purchase them and they take them off the market because there's no one else to buy them. But if they start purchasing, like, banks, just like they bought the toxic real estate from all the failed real estate, they bought it from the banks saying, okay, and they brought it onto their books. If they do this, doesn't the world then look at this and say, okay, we have just lost faith in the system because the Fed owns the banks, owns all the treasury bonds, owns pretty much everything, and doesn't the faith and the trust of the dollar kind of fade away at that point?
Yeah, Dave, I think you've identified the weak link in this basic central bank strategy. And of course, and it's not just the Fed, right? I mean, that the ECB, the European Central Bank has been buying sovereign bonds and who knows what else. And the Chinese Central Bank has been buying apparently stocks directly. I mean, we've heard rumors they've spent a couple of $100 billion supporting their stock bubble. So this whole idea that the central banks can keep the real economy afloat by buying assets at top dollar, that worked in 2008, right? And as you said, I mean, to me, it's astonishing. It is just unbelievable that the Central Bank of the United States owns like over $1 trillion of mortgages. I mean, they own more than 10% of the entire mortgage market, and they owned zero before 2008. They went up and just went in and bought $1.5 trillion of probably mostly sketchy mortgages. We don't know, because once they own it, it's buried, right? And so that was their solution to that problem: buy it and bury it.
And
yeah,
go ahead. I think they're running out of ammunition. That's what I think is happening here. I think they're running out. I understand that, they can do all these things, but we've seen in the past that they haven't really worked. I mean, quantitative easing, yes, it helped the banks, it helped the U.S. government, it helped the wealthy, but it didn't trickle down to the everyday man on the street. I mean, all these things that we're seeing now, the profits of corporations and the stock market rising, it's not really there. I mean, I'm looking every day now, and I see that there are more layoffs from big companies. Profits are down, like Caterpillar, for instance. They're laying off more people. Their profits are way down. They've had like no sales in the last like 32 months, compared to 2008, where there was 19 months of terrible sales. This is 32 months now since, I think, 2012. And it's just not getting better. And they just keep shrinking and shrinking and shrinking. And I'm seeing this all over the place. And I think right now the Fed is really just running out of things to do, because none of it helps the real economy. It helps, the wealthy. It helps the banks. It helps the stock market. But I think everything's starting to separate now of what's real and what's a bubble and what's fake.
Right, Dave, and I totally agree. And I'm not saying that the Fed's purchase of assets will work. I mean, obviously, it's like last straw desperation for a central bank or for a central government to be buying private assets as a way to prop up markets. I mean, that's the definition of desperation. And so, I think you're right that over time, if that's going to be the only solution central banks have to the popping of all these asset bubbles, people will lose faith in the central banks. And then from there, the dominoes start falling, because why would you want to buy an asset that's only propped up by central bank purchases? Because what happens to that asset class if the central bank ever, for whatever reason, stops buying? Well, then it will. Obviously, if it's been propped up when the prop is finally removed, then it will crash to a level that no one can predict because the market's ability to discover price has been destroyed, right, by central bank intervention. And so a lot of people comment on that, and I think it's a very good point. When you start intervening on a permanent basis, then you've taken away the market's ability to price something, which is, and we go, well, what's price discovery? That simply means an open market where buyers and sellers, exchange money for assets. They sell and buy. And so, if you're counting on a central bank's manipulation of the market to hold up your asset value, that's not the same as making that decision or making that bet in an open, transparent market. It's much more fragile because central bank policy is 12 people or something or less sitting in a room, right? And so what we're really doing is we're consolidating all the power over the whole global asset system and into this tiny few people. And so let's say they make a mistake or their policies are failures. Whereas a market is based on millions of people making decisions and doing what they think is best for themselves. And so it has a lot more robustness. It's a lot more stable. And it's not so fragile. But now we've increased the fragility of the whole system to the point where any break will be catastrophic. And that's what I think is worrisome.
Yes, I agree with you on that. And listen, I want to thank you for coming on the X22 Report Spotlight. I really appreciate it. Thank you very much for being on.
Dave, it's my pleasure, and I hope I can catch an invitation in the future for another show.
Absolutely.